Product profitability analysis is often the unsung hero of business strategy, quietly working behind the scenes to ensure that companies not only survive, but thrive in a competitive marketplace. Think of it as the financial health checkup for your products. Just like you wouldn't ignore a persistent cough, businesses can't afford to overlook how their products are performing financially. So, what exactly is product profitability analysis, and why should you care? Let's dive into it. At its core, product profitability analysis is a systematic approach to understanding how much money a product makes for a company versus how much it costs to produce and market that product. It's a bit like balancing your personal budget. You need to know what's coming in and what's going out to make informed financial decisions. In the business world, this means looking at all the revenue generated by a product. Think sales, discounts, and returns, and then subtracting the costs associated with it. These costs can be direct, like raw materials and labor, or indirect, like marketing expenses and overhead costs. Why is this analysis so crucial? Well, imagine you're running a bakery and you've got a signature chocolate cake that everyone loves. You might assume it's your best-selling item, but if you never take a closer look at the cost involved, like the expensive ingredients or the time it takes to bake, you might find that it's not as profitable as you thought. On the flip side, maybe a less popular item, like a simple vanilla cupcake, has lower production costs and sells well enough to be a hidden gem. This is why businesses need to dig deep into their product profitability analysis. It empowers them to make informed decisions about pricing, marketing strategies, and even which products to keep on the shelves. Now, who typically performs this analysis? It's usually the realm of financial analysts or managers who are well-versed in financial principles and business operations. These professionals possess a cocktail of skills: financial analysis, accounting knowledge, business acumen, and data analysis prowess. They're the ones who sift through the numbers and provide insights that can steer a company's strategy. So, how do you go about conducting a product profitability analysis? It's a multi-step process, but here's a simplified breakdown. First, you determine the total revenue for each product by multiplying the price by the number of units sold. Next, you calculate the total direct costs. Those are the expenses you can directly attribute to making the product. After that, you'll want to tally up the indirect expenses, which can include everything from marketing costs to utilities. Finally, you subtract the total costs from the total revenue. If you end up with a positive number, congratulations, your product is profitable. If it's negative, it's time to reevaluate. Let's look at a couple of real-world examples to make this clearer. Picture a company, let's call it ABC Company, that produces 3 products: A, B, and C. They gather data on sales, direct costs, and indirect expenses. After crunching the numbers, they find that product B is their star performer, with a profit of $60,000, while product A is lagging behind. Armed with this insight, ABC Company can decide to focus on optimizing product B's production and marketing while rethinking their approach to product A. In another scenario, we have XYZ Company with 2 products, product X and product Y. After conducting their analysis, they discover that product X breaks even, while product Y generates a modest profit. This prompts them to investigate why product X isn't pulling its weight. Maybe it's time to tweak the pricing or cut down on production costs. Alternatively, they might choose to discontinue product X altogether and channel resources into promoting product Y. Now, it's essential to consider both direct and indirect costs when analyzing product profitability. While direct costs are straightforward, like materials and labor, indirect costs can sneak up on you. If you ignore them, you might think a product is doing well when, in reality, it's not covering its share of the overhead. This holistic view is crucial for understanding the true profitability of a product. When should you perform a product profitability analysis? Ideally, you want to do this when you launch a new product or when there are significant changes in production or pricing strategies. It's also wise to conduct these analyses regularly, especially in fast-paced industries where market conditions can shift rapidly. A yearly review is a good baseline, but if your product has a short life cycle, you might need to look at it quarterly or even monthly. Of course, like any process, product profitability analysis comes with its challenges. Limited data can be a significant hurdle, especially for smaller businesses. Accurately assigning costs can be a tricky business too, particularly when expenses are shared across multiple products. And let's not forget the temptation to overlook indirect costs or make inaccurate assumptions, both of which can lead to misguided conclusions. But it's not all doom and gloom. Businesses can avoid these pitfalls by taking a structured approach. This means being thorough, considering all costs, and regularly updating the analysis to reflect current market conditions. It's also essential to act on the insights gained from the analysis. If you find a product isn't profitable, don't just shrug it off. Make a plan to either improve it or discontinue it. Now, let's talk about the role of customer data in this whole process. Customer data can provide invaluable insights into how products perform across different demographics. By analyzing purchasing habits, businesses can identify which products resonate with specific customer segments and adjust their strategies accordingly. This could mean optimizing pricing or creating targeted marketing campaigns that speak directly to the preferences of those customers. And what happens if profitability decreases? Well, it can lead to a slippery slope. A drop in profitability might prompt a company to cut costs, which could impact employee morale or product quality. If the trend continues, it could hinder the ability to attract investment or secure financing, ultimately putting the business's future at risk. In conclusion, product profitability analysis is a vital tool for any business looking to optimize its operations and ensure long-term success. By understanding the financial dynamics of each product, companies can make informed decisions that enhance profitability. It's not just about crunching numbers. It's about telling the story behind those numbers and using that narrative to drive strategic action. So, whether you're a small business owner or part of a larger organization, embracing product profitability analysis can lead to smarter decisions and a healthier bottom line. Remember, in the world of business, knowledge is power, and understanding your product's profitability is one of the best ways to harness that power.